So good afternoon, everybody. Welcome to the next edition of Market Matters. Today is Tuesday, December 1st, and I hope everyone had a great Thanksgiving holiday. Just basic rules of the road is similar to previous sessions. If you have any questions over the course of the content that we're going to cover today, please use that chat feature within Zoom. I will try to grab those questions as they come in and address one at a time or at the end, but rest assured someone will get back to you either during the session today with myself or your advisor at the end. So with that, let's get started. Similar agenda to previous Market Matters, but I think all have had some interesting dynamics and developments since the last time we did a Market Matters. We're going to go through a COVID-19 update because, again, that still is something that is very top of mind, I think, for everybody, particularly those of us that have had to abstain from holidays with family. Then we're going to go through some economic and investment updates. And then an interesting question that's been posed, and I know Barron's ran an article about this in January of this year, could this possibly be setting up the current situation for a redo of the Roaring 20s? And we'll go through some interesting topical facts around that. First, let's get to the COVID-19 update. Similar slide that you've seen in previous sessions. This is just updated through November 27th, so through last Friday. And what you can see is even over a short 30-day period, there has been some decent movement within the pipeline for COVID-19 vaccines. As you may have seen in the news recently, a number of companies, to include Pfizer, but also AstraZeneca and Moderna, have all touted some very positive results from their drug trials. And, most of those trials are ongoing. So certainly very positive along those lines. However, I would say, just to temper some of the enthusiasm, despite some of these positive results, this winter climate actually does present very unique challenges that we didn't have to deal with in the summertime, meaning that as the colder temperatures wave over both Europe and now North America in a large way, it's going to force a lot of folks indoors, and that's going to create some additional issues with spreading of the COVID-19 virus. So it's I call it the winter of discontent coming. Looking at globally, COVID cases, you can still see we're in a bit of an uptrend, particularly here in the US, and places like Russia and Brazil have now resumed their upward trend, and Iran. Europe does appear to be tapering off a little bit, UK being one of those countries. Germany, you would see, has a similar dynamic associated with their COVID-19 infection rates. But I guess what this means is that we're now in our third wave of infection, each one getting successively bigger. And we're all hoping, of course, that a vaccine arrives in time to stamp out the fourth wave whenever that comes into play. Because, of course, the longer the cycle with COVID infection rates continues or persists, the more economic damage is being done underlying. And of course, the more governments tend to have to step in to support the economies, which presents its own unique set of risks attached to primarily inflation. But for right now, I guess what we're saying here is be ready for a fairly challenging winter period, December, January, February, and looking to the March timeframe for some brighter days ahead. There is some light at the end of the tunnel, though, so I don't want to be all doom and gloom here. This is an estimate that Goldman Sachs put out, which I think is really nice to put together, and it's a compilation of their estimates around vaccine or vaccination timeline. So just for orientation purposes, is the months ahead of us for the next 12 months. On the vertical axis, you can see the percent of the total world population being vaccinated, and by country are these lines here. So the good news is that a significant ramp will occur right around the time I was mentioning that March, April timeframe, where vaccines start to become widely available according to some of their research and their data around pipeline understanding. And then by the end of the third quarter, however, that's really when you've got, I think, most of the at-risk population, or those that are really not in the vulnerable category, would be seeking the vaccination. So under the age of 12. You can see roughly 70% of the global population, maybe close to 80 in some countries, would be vaccinated at the end of the third quarter. So a huge ramp set to come here at the end of Q1 and into Q2. And I think that should be some light at the end of the tunnel for all of us. So that's good news. So let's take a look at the economic and investment updates. Since last we spoke, we did have one update, which I think we'll spend some time on here in a little bit, but most of the ratings have not necessarily changed a whole lot. We did upgrade our small cap viewpoint from like a zero or not attractive at all to a modestly attractive positioning. And really that has everything to do with, is this recovery sustainable, or is it going to have some hiccups along the way? If it's sustainable, then I think small caps could make an interesting addition. But that's really the only thing. And I'll go through some of the other positioning changes that we've had over the last 6 months here shortly. But really, we still tend to be US large company biased at the moment, with some developed and emerging market exposure have made its way into our portfolio over the last 12 to 18 months. And that's been, I think, pretty additive, as you'll see here in just a minute. On the bond side, the changes we made midsummer was we upgraded the quality of our portfolio on the bond side, really so that, when the markets or the equity markets decide to turn lower, we have some good cushion and some diversification within our portfolio that you really wouldn't find with junk bonds or emerging market bonds. Those tend to move with equities up and down. So just some portfolio notes as we head into the home stretch here. We still are increasing the dry powder in the accounts. That's been a nice opportunity to do it because, as you may recall, the 3,600 mark on the S&P was our target for continuing to add cash to this ultra short-term bond ETF. So we're happy to say we've been able to do that here over the last few days and weeks. Obviously, the S&P right now is at 3660, I think, when last I checked. So that's giving us some great opportunities to increase some of the cash position. Markets continue to reflect a vaccine approval here in late 2020 or early 21. So there's a lot of sentiment around these timeframes that's important to just keep in mind if we don't get this understanding. So between now and December 31st, we are looking to actively tax loss harvest. If there is any opportunities, we will look to take those, primarily probably in the bond funds, if there are maybe small losses, or even some of the smaller alternative positions. But we definitely will be looking to tax loss harvest, towards the end of this year, as is our typical policy, because we don't know what capital gains rates are going to be next year, and therefore having some carry forward losses potentially would be very valuable going into 2021. And of course, we do have to watch. There is a very pivotal election, as I was discussing with one of our clients yesterday. There's a very pivotal congressional or Senate election here in Georgia that will decide likely 2 seats in the Senate, which of course would sway the majority one way or the other. And so we're watching not only what the president or President-elect Biden is proposing and some of the details around that policy, but also the likelihood of those policies being passed given the runoff election. And just for reference, I'm going to try to get Mike Townsend from Schwab. He's their chief political analyst back on Market Matters, potentially in January or February. So look forward to that invitation, because I think that's going to be a really nice opportunity to just reflect on what's happened in the runoff. On the equity side, it's been, no doubt about it, been the best November in decades. I think the S&P was up something like 12% for the month, which does provide us with, when you have volatility both up and down, an opportunity to take profits where we've got really good gains, but the valuation might be stretched, and finding other opportunities within the equity space. Small cap being one of them potentially, but also international and emerging markets are getting much more interesting. Remaining, at small, a zero exposure to small cap and mid cap, but we're watching for confirmation of this sustained uptrend to, commit capital. And then going to fixed income here, remaining higher quality, as I mentioned, at a benchmark duration, meaning like how much interest rate sensitivity are we taking within our portfolio. And the real reason that I think that's a sound strategy to employ right now is because the Fed recognizes they can't necessarily let interest rates float much higher, otherwise they risk upsetting the apple cart with the economic recovery. Therefore, by most estimates, most economists polled don't expect interest rates to rise until 2022 or even 2023. I think it's probably going to be a little earlier than that. However, for the foreseeable 12 to 18 months, I think we've got low rates, particularly on the short end, that we can anchor into on our fixed income portfolios. And then finally, our thesis continues to be lower yields right now, potentially even getting to zero in some cases if we hit another air pocket in Q1, but higher yields later. And what would drive yields higher? Well, that would be all the stimulus that we're putting into the economy right now. There's probably another stimulus package, I think, that was just presented today, a bipartisan deal that Mitt Romney was speaking about. Those types of packages, if they're not paid for with tax revenue somewhere else, tend to be or can be inflationary. So we'll be watching for that. And then finally, some adaptations we're making to our overall portfolio approach is that we are now looking at growth alternatives or alternatives on the growth side that are private, particularly in the financial technology space. There's a lot of disruption and change occurring within that industry. And so we think there's some really interesting opportunities to gain access to if you know where to look. So let's take a look at some of the monetary policy backdrop. The monetary policy is just what are the central banks doing? And so you can see here on the chart, it reflects not only the size of the balance sheets outstanding or the amount of capital that the central banks have added to the markets and the fixed income market in particular since 2005. And more recently, you can see this year a huge ramp up in monetary policy expansion going into COVID as a rate to COVID, but also you can see what happened here to the Fed funds rate, the interest rate. While it crept up above 2% there towards the middle of 2018 and 19, it's now back at zero. So what is this telling us? It's telling us that interest rates, at least on the Fed funds rate, don't really have much way to go down any further from here. But certainly I think the likely outlet, if there needs to be more stimulus, would be from the balance sheet, meaning asset purchases. The Fed and other central banks would look to likely continue to purchase bonds in large quantities if the economy looked like it was rolling over to stimulate. And, looking at, this is often a question I know that comes up from clients is that, we've got a all-time high budget deficit. So and that's reflected here on the chart. It's a picture of the outlays of the federal government in the green line here as a percent of the economy. So we're spending roughly 33% of our economy right now in outlays and only taking in revenue of roughly 17% of the economy. So that's creating a pretty massive gap in the budget deficits. This is the budget deficit right here, which a lot of budget hawks like to point out. And certainly, while I think this is something that needs to close back to a much more sustainable level, like it was potentially, in the mid 2000s or even in the mid 2010s, this is not going to close anytime soon, primarily because we've got such a deep hole to dig out of from COVID. And this is one reason why finding this solution to a vaccine is so important, because you can only, this gap, this jaws here between outlays and revenue can only persist so long before inflation really starts to become a problem if the governments decide they need to step in and support at every opportunity. So this is why we have an intense look at this budget deficit and the COVID vaccine schedule. But the good news is that, in the meantime, while it does look to be a challenging winter, there are certain parts of the economy that are doing exceptionally well right now, and likely as it relates to COVID. And this is the housing market. What you're seeing on the screen right now is a picture of the Case-Shiller Home Price Index. And this is just a national measure, top 10 markets, top 20 markets, and the national index. And you can see what's happening here is that as more people are staying at home, as more companies are allowing workers to work virtual, that people are moving around, likely from apartments in very crowded or dense central business districts in some cases into suburban areas. And I think that's certainly occurring in a number of different submarkets, to the tune of the home housing market is now absolutely on fire. I mean, you've got the national home price index rising at above 7% rate. And that hasn't happened since 2013, coming out of the collapse, but also, going back to these other periods like in 98 and 2005, 6, things of that nature. And the key is that it's in an uptrend, not a downtrend as well either. So, if I had to guess, housing prices will continue to remain pretty firm, if not appreciating, for the foreseeable future as people get settled in different living situations that might be more affordable than a central business district. But all this moving around creates economic activity. Not only is it, home improvement industry, but also retailers and, the construction industry. And those are big industries that need a lot of demand or a lot of support right now. And that's really going to, I think, carry us through the first quarter, in a decent way. So it's really supportive to have the housing market as a tailwind to our back right now. Looking at equities for the moment. So now we've got a fairly bullish background from monetary policy. We're likely to have some stimulus coming. We've got some support from certain sectors of the economy. Equities are actually responding, as you might expect, with all of these tailwinds essentially at our back. And furthermore, as I mentioned in the last Market Matters, companies are taking dramatic actions, not only from a cost containment standpoint, but also investing for productivity. And it's no surprise that, for 2 quarters in a row now, S&P 500 companies have beat the average analyst estimates by double digits. And that's part of the reason why we've got equity markets where they are right now. But they definitely have brushed off any election anxiety. And, you can see here some of the, as I mentioned, some of the catch up that's happened within the small cap index that was once a real drag for the small cap index is now almost pulling even with the S&P, particularly over the last month and a half. And this is something that we've been watching pretty carefully. As you know, we've been waiting for a better opportunity for small cap. And, while valuations are still a bit challenged on the small cap side, most of our core allocation right now remains in the US large cap side, primarily because those companies are just dominating industries, particularly, the top companies in those industries. Interestingly, however, emerging markets, which as you may recall, we added to earlier in the year, has also caught up to a almost S&P-like return, and that's been very value additive to our international sleeve. And the broader international developed stock market continues to just kind of hum along, really at that, maintaining that gap they've had here for the better part of 6 months or so. We do have some exposure, but in active strategies. So, and those active strategies are working pretty well. And this is what I was talking about with the small cap index. Small cap stocks are starting to attract our attention again. And what you see on the screen right here is a ratio chart. It's basically the small cap index divided by the large cap index. And the way you read ratio indexes is if this line is going up, it means that small caps are outperforming relative to large. If the line is going down, it means that large companies are outperforming relative to small. And you can see, this goes back to 2001 essentially. But, big outperformance of small caps for about, 10, 11 years, and then went sideways for a little bit. And then recently large companies starting in about 2013 or 14 have really started to outperform small cap in a pretty massive way until recently. And this is really post-COVID. There's been a lot of chop around here, but small caps in relative terms have actually started to outperform large again. So we'll certainly be waiting to see if this is a sustainable uptrend, but this is definitely getting our attention because again, we have no small cap exposure right now. So we're I think coming at it from a position of strength here, and we'll be very judicious about making that decision. But that's one thing we're looking at right now. And what I think is also important to keep in mind is that, the rally we've got right now in the S&P, call it roughly 14% for the year, which is just staggering to think about even 6 months ago, has really been in the absence of one of the biggest supports for the market over the last 10 years. And what I mean by that is this rally to new all-time highs has occurred essentially without the help of any stock buybacks. And you can see that really clearly here. So weekly amount of buybacks are in these green lines here. The 3-month average of those green lines is in this blue line. And what you see here is that we're at an all-time low level of buyback activity, at least going, not all-time low, but going back to at least 2014. where we're hitting new all-time highs without the support of corporate stock buybacks. And my point here is, just imagine if those restarted again, if corporate treasurers got bullish on their stock prices or the stock market, because that is an opportunity, especially with rates at zero. I think that more CFOs will start to look at. So that's, I think, a bullish support for the market right now. Moving to fixed income here real quick. Still continues to be a little bit of a sideways action for the government bond markets. That's this red line here. It's the aggregate bond market, aggregate bond index. Really hasn't done anything for 6 months or so. 10-year bond yield is right around 85 or 86 basis points this morning. But other parts of the market, the more riskier parts of the market, the corporate bond market, emerging market bonds, and high yield bonds have all kind of started climbing up in anticipation of, I think, better times ahead for the economy, because those are all fairly sensitive to changes in the economic output. And so I guess the only point, though, however, is that I wanted to make with this chart is that we're kind of nearing lows on the investment grade index, as well as the emerging market bond index and the junk market index. And it's kind of like picking up pennies in front of a steamroller, if you ask me. It's just not worth it to take a lot of risk in fixed income right now until we get better opportunities like we saw back in March. So we'll be waiting patiently for those opportunities. And another support, of course, for equities is this chart right here. And what you see is the amount of global negative yielding debt. I mean, it's just a fascinating concept to try to wrap your head around. But we're here now at these kind of all-time high levels of global negative yielding debt. This will, I think, in turn support, other alternatives, particularly things like equities or private markets, because if people need to go other places for yield or even capital appreciation for that matter, they're going to do it at the expense of their bond portfolios. Now, again, we have the luxury in the US right now of having positive rates all across our yield curve. So everything from the 3-month treasury bill to the 30-year T-bond is still nicely positive. But if that dynamic decides to move in the direction of a Japan or a Europe, we've got a playbook. We're putting together a playbook for that. And we'll have some recommendations for you in the case that does happen. So now we'll get real briefly here to this roaring 20s analogy, because I do think it's a great analogy, although some parts would apply and some wouldn't. This is from The Great Gatsby, of course. And I think a lot of the line of questioning is coming from clients that have, read the Barron's article or just heard it in conversation, because there are a lot of similarities. And here are just a few that I could pull out, just thinking about it for a little while. Very similar in the 1918 was obviously the Spanish flu, which led to a mild recession in 1919. In current day, obviously, we had a pandemic in 2020, which led to a fairly mild recession, the sharpest, the deepest recession, but also the quickest to recover in 2020. So very similar here. Interestingly, if you look back at it, the 1920s were an era of massive innovation and new technologies. And by that, new technologies back in those days were things like the Model T, which was perfected by Henry Ford, of course, on the assembly line. Electricity, getting electricity much more distributed into homes as opposed to just inner cities. Things like refrigeration or the vacuum, which all led in some small part to large gains in productivity and efficiency. And I do think there is an interesting analogy to today, although with different dynamics. One is that you've got some of the new technologies are artificial intelligence, autonomous vehicles, the adoption of 5G, that's the ability to stream essentially broadband type speeds over wireless networks. And then health sciences innovations that are coming maybe in a lot of ways as a result of what's happening with the pandemic right now. It's ushering in much faster gains in technology in those sectors than maybe otherwise would be. The only difference, I think, with the 20s versus the 2020s is that all these technologies here, I think, tend to be deflationary, which means that artificial intelligence, autonomous vehicles, in particular, are going to be putting people out of work in some cases. So that certainly led to, I guess, could maybe be a corollary back in the 1920s. But these technologies created jobs in large parts of the economy. These will actually likely have a way of thinning out jobs in certain parts of the economy. So not necessarily a great corollary, but they all both have the likelihood of creating large productivity gains within the workforce. And then unfortunately, the one thing that I could pull out that was very similar from the 20s to today is that income inequality reached its highest level ever in the 20s, with gains, almost all the gains accruing to the top 1%. We're very similar situation today, although not quite as disparate as it was in the 20s. But most of the income gains have accrued to those of us that are lucky enough to own stocks and have good jobs. Unfortunately, the lower 50th percentile called that doesn't own stocks and doesn't have assets necessarily hasn't really benefited that very much, and that shows up in average hourly earnings and wages. So I guess to net it all out here, using some of these historical contexts, productivity does look like it's set to increase, but I think it's going to come at the expense of jobs here in the United States or the developed world, which is a bit different than in the 1920s, where productivity gains actually led to new industries being created and large parts of manual labor opening up to service some of those needs and technologies that came out. But the key is, of course, how will these gains be allocated? I would refresh this slide from last week as well too, is that, what does the 2020s potentially hold for us? And, I'll go back to this investment implications of, having split Congress. I would say, well, split Congress, but also Democratic president. These are just the stats all the way back to 1928. So it's a useful analogy. It doesn't quite pull in the 20s, but the latter part of the 20s. And if history is any guide, then it's a decent, mid-single digit, actually really good, mid-teens type returns on equities, which I think that's a little aggressive given where valuations are right now, but still not a bad, tailwind from historical context to fall back on. But so how did things actually work, in inflation adjusted terms in the S&P? I mean, what actually ended up happening? So in the 1910s, we had, middle teens, 19s, we had rising inflation largely from World War I. Remember that kicked off in 1918 and concluded in 1914 and concluded in 1918, which meant that, and recall from previous market matters, one of the big things that saps stock market returns tends to be inflation. And so when you have rising inflation, stocks don't tend to respond very well. So, actually over the 1910s, you had a total return of about negative 60% from 1910 to 1920. That was, of course, followed by roughly a 400% gain in the stock market. You can see here in inflation adjusted terms, as productivity gains kicked in, inflation came down, and that just led to a massive boom in all across the workforce, which was interesting to note, because I didn't realize it was that big in inflation adjusted terms. Contrast that with what we just came out of, which was the 2010s, which was where we had an era of falling inflation, driven by primarily demographics, but also productivity gains that supported a market rise in inflation adjusted terms of about 300% from January of 2010 to where we are today in November of 2020 or December 2020. Following this pattern of the 1920s would suggest that it's going to be a very difficult pattern to replicate as the 1920s, because we're coming from an era of falling inflation, not rising inflation, and also you've got much higher valuations as a byproduct of that falling inflation, and therefore this is likely to be challenging to repeat as the 1920s. I would say, however, we still do expect the 2020s to be positive, and it'll be even more positive if you're applying active strategies. But just something to keep in mind, it's not a very useful, or it would be very challenging to replicate the 1920s activity. So just summing it all up here, just wanted to touch on, and I'll get to a question here from someone in the audience. But just some key takeaways, very similar to the last time we were together, which is equity markets we still think are set to generate lower yet positive returns over the next 10 years, punctuated by some very sharp sell-offs. I mean, that's going to be the price to pay for zero interest rates. It's going to be higher volatility in areas that won't be manipulated by the central banks or other institutions. And so we need to remain flexible, and then active positioning will, I think, be a key piece of the value proposition here, as to how you decide to move in and between asset categories and stocks in particular. Having a programmatic rebalancing process is, I think, ideally set up for this type of environment. And it's created already an exceptional amount of value this year within our equity strategies in particular. And this is being created by volatility within those categories. So I guess the sum is be ready for that. And then also getting back to the yield piece, because this is a key piece, lower yields now, but higher yields later. And we're very keen to watch out for inflation. So this will be not only a marker for when a value rotation might be sustainable, if it shows up, same thing with small cap, but also would be a key catalyst to look at moving into things like treasury inflation protected bonds, as opposed to fixed rate bonds that might be do better in a falling interest rate environment. So let me just take or pause there and just take a question from the audience, and that was, do you see any of Biden's picks for cabinet posts having a significant impact on the market? From what I've seen so far, it's not been a very radical slate that he's proposing. I think he still has some key economic advisory positions that he needs to fill out. So I think certainly that would be positions that we would want to hone in on. I mean, for example, Trump's appointment of Larry Kudlow was, I think, one of the key reasons why we had, a tax cuts, the Tax and Jobs Act 2018. But, because we don't have any definitive names that have been identified yet on some of those key cabinet posts, everything else, as far as I can tell right now, would be too radical of an appointment. So thanks for that question. I appreciate it. There is one more question that came in, which is, do you see the blockchain technologies being disruptive to the banking industry? Thanks for that question. I absolutely do. And that is one of the opportunities I was referencing, particularly within the private markets on the fintech side. How does the intersection of cryptocurrency, but also blockchain, impact the banking industry and the banking sector? And I see no immediate impact right now, because I think a lot of the players, like particularly the bigger banks, are still trying to figure out how they would actually use the technology. Bitcoin is a little bit different in that I think its only use case in the future is going to be as a digital gold, essentially. But all the other cryptocurrencies out there, everything from Ethereum to Ripple to others that are maybe top of mind, I think have an absolute place in the longer term economy. We'll just see how they settle in, but it's still kind of the Wild West right now, which is also what makes maybe some opportunities in that space on the blockchain side in particular really interesting. So we look forward to updating you on any of those findings in the future Market Matters. So thanks for that question. I appreciate it. Just wanted to say thank you for spending some time with us today. Really appreciate it. Tune in again in January. I'm not sure if it's going to be the first week of January, but it might be the second week for our Market Matters episode, because we'll just be getting back from the New Year's holiday. Thanks again for your time today.